Welcome to Intermediate Corporate Finance. This video, we will start our discussion with the definition of marginal investors, right? In who is the marginal investor in any given stock, right? It depends on the company's characteristic, but usually the big corporations listed in the stock market, who are the marginal investors? And then why do we care? Depending on the characteristic of it, our choice of model, right, the required rate of return will differ. Later you will see it. Now, the definition of it, what is a marginal investor? Who determines the stock price in the market? Okay, is the question. Of course, everyone is a price taker who cannot arbitrarily manipulate prices, but when trades occur through market clearing, demand and equal supplies, then the price is determined by those very investors who are buying and selling at the last dollar. Okay, 한계 투자자. Okay, at the last dollar, buying and selling. Those are called marginal investors. They are not price manipulators. No, not dark forces. They are not leveraged institutional investors. No, they are not. It's not about institutions who are buying with borrowed money, leveraged position. No, 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 no. Who are those? Just the institutional investors in general. For example, BlackRock, Fidelity, big mutual fund kind of guys. They are usually marginal investors who buy or sell at their last dollar of transaction. Okay, why is that the case? Why is the marginal investor an institution with a fully diversified portfolio rather than a retail investor in most cases? Is a valid question. In the process of determining the market price of Hanwha stock, let's say you are interested in Hanwha, okay? Why Hanwha? That's my favorite thing these days. You will see why later. And which of the following is more likely to be the marginal investor? Let's say the first guy is Mr. Andy Kim, a retail investor who invests only in Hanwha. 100% of my money is invested in Hanwha. Or Korea Investment Corporation, KIC, which boasts a fully diversified portfolio. Okay, each submit a bid order for Hanwha stock, but will only bid a price equal to their own estimated intrinsic value. Let's assume, apart from the discount rate, both investors are given the exact same information about Hanwha, and both apply the following DCF model. So for the same Hanwha, the valuation estimate of Andy about Hanwha will be equal to Hanwha's future cash flow discounted at relevant cost of capital Andy applies minus the growth rate of the cash flow expected based on the information given by Hanwha. And then how about the valuation number by KIC, the diversified investor, about Hanwha? That should be equal to cash flow, the same cash flow of Hanwha, discounted at relevant cost of capital that KIC assigns, minus the growth rate of the cash flow of Hanwha, which is identical to the growth rate that Andy uses. So Andy and KIC both use identical cash flow estimates and identical growth rate estimation. But the only thing that differ will be RH of Andy and RH of KIC, the discount rate. Then which valuation number will be bigger, larger? Okay, V Andy or V KIC? Then ultimately this reduces to the question of which is smaller, R of Andy or R of KIC. The discount rate I apply to Hanwha or the discount rate KIC assigned to the Hanwha. Okay? Aren't they the same? Well, wait a minute. Retail investors Andy Kim, as the representative of small investors, does not hold a diversified portfolio. In fact, he plans to go all in on Hanwha. Therefore, Andy is fully exposed to the total risk of Hanwha. That is both the firm-specific risk, the chairman, idiosyncratic action, and systematic risk. By contrast, KIC holds a perfectly diversified portfolio. Thus, the KIC portfolio manager does not need to worry about Hanwha's idiosyncratic risk. Okay, so what's the difference? Okay, here is an interesting thing. If the Hanwha's chairman makes a blunder that causes Hanwha's stock prices to fall, other competing firms' stock in the portfolio will likely perform well and offset the loss. Okay. For example, Hanwha's chairman, okay, Kim Seung-yeon 회장님, had a history of beating the waiters in a drinking place because the waiters beat Mr. Kim's son, okay, Bukchangdong, right? So he almost kidnapped those guys to the waiters to the Cheonggaesan, the mountain area, with his bodyguard, and then with the baseball bat he was beating like boom, boom, boom to these waiters. And guess what happened to the stock price of Hanwha at that revelation? And then, so likewise, the Hanwha stock got punished and then went down with the idiosyncratic accident associated with this chairman risk, right? Idiosyncratic. So for me, I'm 100% invested in Hanwha. So each and every mistake this chairman makes, I will be really, really worried about it. Okay. So my discount rate R and D of Hanwha will be big because I am 100% invested in this company. I'm worried about all these idiosyncratic risk. Whereas KIC, they don't care about this kind of idiosyncratic risk because, well, Hanwha stock goes down, then bad news to Hanwha may be a good news to its competitors, and KIC holds the competitors' stocks as well. 어장 관리를 잘하고 있어요. It's like they are well positioned to get over that kind of idiosyncratic damage. So the discount rate KIC assigns on Hanwha will be smaller than the discount rate that I assign, so that with the same cash flow and growth numbers, the valuation estimate will be much bigger for KIC, even for the same company Hanwha, when it comes compared to Andy's valuation number, right? So in a rational bidding process, who can bid higher? KIC can bid higher, and he will that fund will take that buy the Hanwha stock and determine the price at the last dollar. That's the concept of marginal investor. Me as an individual investor, I cannot be that kind of marginal investor usually, right? Because I am exposed to those idiosyncratic risks. Okay, so so price is usually determined by these marginal investors, and we have to take the perspective of these marginal investors. For large corporations, publicly traded corporations, those marginal investors are usually KIC kind of well-diversified portfolio managers. So we have to take their perspective, not Andy Kim's perspective or individual investors' perspective. So large investors, right, marginal investors' perspective, portfolio management. So that is why we have to care about the portfolio theory. Okay, does building a portfolio really reduce risk to a certain level is the question, and this is what you already learned in your financial management, right? Here I show you with one example. The 30 riskiest stock among Kospi 200. I show you. For international students, sorry about this name of the company, but Kumyang and TCC Steel. Kumyang turned out to be the riskiest stock in Korean market, and then and 35% up and down, right? I think it was the annualized return, is that right? Yeah. And then not annualized, but monthly return, and then stock return volatility, okay, stock return volatility, which is a standard deviation of the stock returns, monthly returns. So 35% standard deviation. And then the second riskiest stock was TCC Steel, and all the way down, and then going down to 한국 Korea Gas Public Corporation, the safest one, energy stock in that period. That was, we did not have the U.S.-Iran war at that time, so this stock was rather safe in that sense. Anyway, so that was how it lined up in terms of total risk of each individual stocks, right? So you can rank them like in this order. But my question is, well, if you form a portfolio based on these stocks, and then gradually starting from Kumyang, and gradually you include the second riskiest stock, and then plot the total standard deviation of the portfolio's return, then how does it look like is the question here. Okay, so again, in the previous diagram here in the graph, each bar showed the standard deviation of monthly returns of each different stocks. I just ranked them in order of riskiness, going down. Second riskiest stock, third riskiest stock, last one. Now the next one is like what? In the first bar shows the portfolio's standard deviation of returns when the portfolio has only one stock, 100% invested in Kumyang, so that the portfolio standard deviation stays the same as the picture before. It's 100% invested in it, but the second graph here shows 50-50 portfolio between Kumyang and TCC Steel. Over here, their standard deviation of portfolio return, 50-50 portfolio between these two. That's why this TCC Steel standard deviation return standard deviation is different from the portfolio's standard deviation like this. And then the third bar graph over here is 1/3 invested in Kumyang, 1/3 invested in TCC, 1/3 invested in Tusan Pure Cell, right? So this is a standard deviation of portfolio return of 1/3, 1/3, 1/3 portfolio over here, whereas this one is the standard deviation of return of only one stock, Tusan Pure Cell, fuel cell, all right? And then the fourth one is a portfolio standard deviation when we invest a quarter in Kumyang, a quarter in TCC, a quarter in Tusan Fuel Cell, and a quarter in POSCO DX, right? And as you move to the right, I just include one more stock, and the portfolio is assumed to be 1/n, right? Equally weighted portfolios, equally weighted diversified portfolios. As we increase the number of stocks, just cumulatively just add those things. Then I wanted to show how the total risk of the portfolio changes as I include more and more stock over here. So on the last bar graph over here is the portfolio standard deviation, where 30 different stocks are included, okay, equally weighted and included in this portfolio. Then you will see very interesting phenomena. The portfolio's total return, okay, gradually goes down very fast, but up to certain level. Beyond certain level, it does not go down, okay? And then compared to the first graph over here, the 30th stock, 한국공사, right? If you invest 100% of your money into this Korea Gas Corporation, the total risk of your 100% concentrated portfolio will be about 16%, right? Monthly standard deviation. But if you put well-diversified portfolio, 1/30th of all these different stocks, then your portfolio's risk will be much lower, about 10% return. This is way smaller than the 16% return than before. So likewise, as you form portfolios, right? As you form portfolios, you can reduce your portfolio risk, okay, up to certain level, and but at the same time, there is some component of the risk, portfolio risk, that you cannot just get remove, right? We call this systematic risk, the risk that just does not go away, even though you form well-diversified portfolio. Systematic risk, the part of the risk that disappears as you form portfolios, this part is called idiosyncratic risk. Okay, idiosyncratic risk. And then, so these two, okay, idiosyncratic versus systematic risk distinction is very, very important. Very, very important. Okay, why? This part, the systematic risk component, it matters to marginal investors like KIC that we talked about before. But idiosyncratic risk, okay, does not matter to KIC kind of guys. You remember this discussion over here, right? KIC versus Andy, right? KIC versus Andy. And then this part of idiosyncratic risk is, Andy will be Andy or individual investors will have to worry about both individual idiosyncratic risk and systematic risk, both, so that R will be higher and V will be lower. In contrast, for KIC kind of well-diversified portfolios, they don't have to worry about that part. All they have to worry about is this systematic risk component, okay? So that the R will be much lower and then the V will be much higher. They can afford to pay high, okay? And so which will be larger, ultimately it reduces down. I told you about this and that, right? KIC fund manager will win the bidding war against Andy and buy the stock of Hanwha and set the price. And Andy will be simply the price taker. For all companies in the world, is the marginal investor always a perfectly diversified fund like KIC? Think about it, right? For about 5 seconds, right? For all kinds of companies in the world. Well, for example, for privately held companies that are not listed in the stock market, for example, at this point, Tosbank kind of small fintech companies, right? Found kind of small fintech companies. Would their marginal investors be also KIC kind of well-diversified portfolio managers, right? The answer is no. Privately held companies, their marginal investors would be more likely to be private equity companies. Also, it may be individual investors in smaller companies' cases. Why? Smaller companies, not traded in the stock market, right? They are not held by this well-diversified portfolio managers, and because of many reasons. Big, well-diversified portfolio managers, they tend to work for insurance companies and pension fund companies, and by law of those funds, they cannot invest in small-sized companies and private companies because they are too risky, okay? Also, privately held companies, by definition, right? It's closely held by founders and their families, right? So they tend to be more marginal investors in those small company setting. So when you value private companies, your discount rate model will be slightly modified. That's something you're going to learn at the final part of the semester if we have some time. But for general purpose, right, throughout this semester, most of the cases, we just have to worry about the general case of big corporations, okay? Samsung Electronics or big corporations, their marginal investors are well-diversified portfolio managers. So what's the consequence? You just have to worry about CAPM model, and then that kind of thing will save your day for your project purpose. Why do we need to consider who the marginal investors is for each stock? For most listed companies, marginal investors being equal to diversified investors, but not for unlisted stocks, private stock companies. When valuing unlisted stocks, the method of calculating the required rate of return is different. So you're going to learn about it later. And then in the next video, we're going to talk about the question the marginal investors ask when looking at the Hanwha stock. Okay, so how can we model the risk-return trade-off using the marginal investors' perspective? So wait for that. Thanks for watching.